What is up, everybody, and welcome back to another episode of this day trading bootcamp. Today's episode is pretty important because I'm talking about high time frame analysis. What this high time frame analysis enables you to do is take what you learned about liquidity and take what you learned about market structure and fair value gaps, highs and lows, all of this, and turn it into a general idea that you can make for yourself on where the market is going and what the market is reacting off of. It's extremely important that you get good at doing this because you have to do this every single day just to figure out the draw on liquidity and where the market is trading to in order to set yourself up to take proper trades in that direction. This is kind of a stepping stone for our daily bias video, which is coming on in a later episode. So make sure you buckle in and you lock in because this is hands down the fundamental system that you will be using every day when you form your trades. All right, get out your pens and paper and let's dive right into what the high time frame is and how we analyze it and why it's important. So what the high time frame is just the 4 hour, the 1 hour, and the 30-minute chart. The reason why we use this for the high time frame is because considering there's a lot of price going on in here and a lot of price action, a lot of orders because the candles are 4 hours, they're 1 hour. So any sort of liquidity pool or fair value gap is going to be important because there's a shit ton of orders in there because it's from a large area of time. So on this time frame, what is relevant to us? High time frame highs and lows, which is just the high and the low of the candle. You know what those are. Don't have to get any more into that. High time frame fair value gaps. So a 4 hour fair value gap, a 1 hour fair value gap. As you know, a fair value gap is an imbalance of price with tons of resting orders. So these are super relevant to us when we are charting up on these time frames. The general market structure. Obviously, you need to know if in the high time frame you're in an uptrend or if you're in a downtrend. That's just pretty self-explanatory. And then the question you have to ask yourself is, what is being respected versus disrespected? So for that, you look into the market structure, seeing if you're in an uptrend and you're in a downtrend, and you combine that with fair value gaps like we talked about in our last video. So you see if we're respecting 1 hour bullish fair value gaps and disrespecting bearish fair value gaps, that's just another sign that you're in that uptrend. All right, now let's get on to the why. Why is this relevant? Well, orders rest in these areas, obviously. At these highs and lows and in these gaps, there's tons of resting orders just waiting to be filled and waiting to send price in a specific direction. And then what this enables you to do is obviously predict the next area of liquidity that can get hit because other areas of liquidity are sending price in that direction. Okay, let's move on to a beautiful Mozart level example of this that I prepared for us. So bullish structure and liquidity versus bearish structure and liquidity on the high time frame and what this might look like. I'll start out with a bullish example. So you can see clearly, as you know from the market structure video, higher highs, higher lows, higher highs, higher lows, higher highs, we're in an uptrend. And then you see us make a move down, tap into a bullish fair value gap where you know there's resting orders, on top of sweeping out a bullish low, reacting off of it, and then you see an IFVG, an inversion fair value gap, out of there showing you we're once again disrespecting those bearish fair value gaps. That's just a telltale sign that we're bullish. So then what you can do with this is predict the next area of price where it will go, which would be the next area of liquidity, which would be this high. Now for our bearish example, same thing, just flipped upside down. You have your lower lows, lower highs, lower lows, lower highs, lower lows. Then you see market come up, tap into this high time frame fair value gap, respect it on top of sweeping a high and reacting off of it, giving you a bullish fair value gap, getting inverse to the downside. You can only imagine that we're going to continue this trend 95% of the time, hitting the next area of liquidity. Because why wouldn't we? You know where the orders are. You know what they do. You know where they're sending price. There's no reason we wouldn't go to this low because these orders are telling you, and these examples and these signs are telling you that the order flow is going in that direction. Now, when I say all this and I'm dropping all this on you at once, this might sound confusing, might be a little lost. Don't worry. We're going to apply this on the charts and do a few examples together, and then you can do this on your own and backtest this, and you'll see it's really a lot easier than it sounds. All these fancy terms make it seem much harder than it is. Really, you're just looking for what rectangles are being closed through and where our highs and lows are. In a super simple way, that's all you're doing. Okay, I picked a random area of price and I'm on the 4 hour time frame. So I'm on the high time frame. Let's do our analysis. Let's figure out what's relevant to us. So what I see, we have a high, we have a low. We just swept this low and we are now trading into a big, massive 4 hour bullish fair value gap. All you need to figure out is if we go below this fair value gap, we'll probably go to this next area of price. If we hold this and see a sign that we're going to go up, we'll probably go to this high. Okay, stopping price right here. What did you see happen? We made a fair value gap and then we inversed it on this candle to the upside. The only other place we have left to go is this high. We respected a bullish fair value gap, we disrespected a bearish fair value gap, and we continued on to the next high. All right, I just moved on to a new area of price. Let's do the same thing. Let's mark out our liquidity pools. We have a low. We have a low. And we have a big fair value gap right here, bullish fair value gap. And we have a smaller bullish fair value gap right here. I let price play out. We inverse this fair value gap. Does this mean I'm bearish to these lows? No. Why? We just swept these lows and we're still holding this bullish fair value gap. So I know until we close below this fair value gap, we can't see these lows. If we respect this, we might continue higher. If we disrespect that, we'll go to these lows. Now, just make note of something. This candle came down below this fair value gap. Am I bearish? No, we didn't inverse it. In order to inverse it, the body has to close below the fair value gap. We're not bearish yet until this fair value gap gets closed below. Don't get faked out by any of this. Bang! Inversion. What could happen here? We're probably going to see the lows. We just inverse this fair value gap to the downside. This is our next closest draw. We have nothing to the upside that could really get taken out. We have some sort of highs up here. These might get swept, but we know we're in bearish order flow because this fair value gap just got inversed. Let's let it play out. We take the lows. It's super simple stuff. All right, I could sit here and do this all day, but once you understand these high time frame liquidity pools and why they're relevant and how to understand where they're sending price or if they're getting disrespected, price might go, you can make a super clear high time frame analysis of where you think price action is telling you the next draw on liquidity is. I like to think of it in this way. Let price tell you a story. All you have to ask yourself is, what is sending price? Where? Why is price going here? You have to look for the signs that are showing you this might be sending price in this direction, or we have this, which might prevent price to getting to this certain point. You have to think of it like a book. Think of it like a story and watch what might happen using the context clues from the past to send price in a certain direction. So you have homework. Go onto the charts. I encourage you to do this. Go onto the charts. Go onto bar replay. Use the bar replay tool, which I'll show you where it is. Right here. TradingView implements a tool, this line called bar replay. All you have to do is click it, click start new, and then select a random area of price. And all you have to do is click play at the bottom of your screen, and you can see price play out in live time in front of you. Super useful tool. This is how you should be backtesting. Use this tool, gather the information, see it for yourself, and then you'll understand the high time frame draws on liquidity, and you'll actually be able to see the orders get filled in live time in front of you. And it's going to be super satisfying to see. You're going to understand it. You're going to feel like you learned something, like you're being productive. It's great. That was all I had for the high time frame analysis video. This is kind of the foreshadowing video into our daily bias, which we will get into. It's just a little bit more complex. We have to add a few more confluences in there before we get there, but you get the gist. This is how you analyze the high time frame. Link in the description for the Discord server. I live trade every day for free. I have tons of free resources on my model. Join that, like the video, and I will see you in the next episode of the Bootcamp. Stick with it and test it for yourself.